And good morning once again, options traders. Well, during one of the calls that I had recently, a trader was talking about selling puts to hedge his long shares of stock. And I think everybody in this, at least most of you in this channel, know that options were really designed to hedge. And virtually every single strategy has some element of a hedge to it, but some are certainly much better than others. So I thought it would be helpful to talk about that, and specifically for selling puts against long shares, because it is something that a lot of traders like to do. So let's look at it. What do you think? Is a short put a hedge for long shares? Well, first let's start off with hedging. A brief definition, remember, is that the basic idea is that you are giving up some of the potential gains in exchange for sharply reducing potential losses. That's probably a pretty good definition and a pretty good metric to see if it's a hedge. Now, also remember that option buyers have rights. This is one of the main reasons that we buy options, and that options were created, again, as hedging tools, and that's if you are the buyer, that you are buying some type of right. On the flip side of the trade, option sellers have obligations. So that's the key word right there, is that whenever you are selling an option, whether a call or a put, you have some type of obligation. And so you have to say, is that really a good hedge? Well, yes, when you sell an option, it is true that you're going to receive cash, and that can reduce some potential risks. But the cash by itself will definitely give you some type of limitation against losses. But the question we want to figure out here, is it really a good hedge? Now, something else to think about is that not all traders can be hedging. Why? Because for every long position, there is a short position. And so not all of the traders can be reducing risk or can be hedging. So that's another way to understand that it's certainly not possible for everybody to be hedging. The only way that you can hedge is because somebody else is willing to speculate. Some people, in some instances, will want to be speculators. Others will want to be hedgers. Well, who are these people? I have no idea. Well, guess what? The options market will figure it out. All you have to do is look at the bid and the ask. Do you want to buy an option or do you want to sell an option? Let the traders figure it out. So let's go and take a look at this strategy of buying shares and selling a put and see if it really qualifies as a good hedge. So here's a risk graph for shares of stock purchased for 100. We break even right here at a price of 100. And other than that, we are dollar for dollar up and dollar for dollar down. Now, if we change this black line here, the risk graph for the shares of stock, to one of a short put on top of this. So in other words, we're going to be long the shares of stock in black, but we're also going to sell a put. Let's say that maybe we sell the $95 put for $5. And if that's true, we're going to shift from the black line to the red. So on one hand, yes, you can see that the break-even point for the black has been shifted a little bit this way to the left. That's the $5 that you collected from selling that option. We can also see that there is an additional gain if the stock price rises. Do you see how that red line sits above the black? In other words, by holding the stock, obviously you're making dollar for dollar up. But if you sell that put, you are also making dollar for dollar up plus the $5 from selling that put. So this is actually, or at least in a portion of this graph, increasing the potential returns. And that should be a little clue right there. But what else do we see? Even bigger down here. Take a look at this. When you were on the black line, you had delta 1. What happens when you're long shares of stock and you sell a put? You've now swung this line here in black down to this one in red. And that's because you have doubled the risk. Why? Well, when you owned 100 shares of stock, you had 100 deltas. But when you sell the put on top of that, in this region, for all stock prices below the strike, you now have 200 deltas. And that's because you own 100 shares currently, but you're also on the hook to potentially buy another 100 shares. Remember, when you sell a put, you have the potential obligation to buy shares. So yes, that's going to mathematically expose you as if you are long shares of stock now. So this is really the thing that you want to look at. Always compare the before and after. If you look at the black line, holding just the shares of stock, yes, when you sell the put, you did reduce the downside a little bit, but you also increased the potential gains and you increased the risk. So what is it whenever you increase the potential reward by increasing the risk? That's far more in line with speculation than a hedge. And also remember that option sellers accept risk. So this should be another clue. If you are selling options in there, it is primarily accepting a risk in exchange for more reward. And yes, in the process, the cash that you brought in might give you a little bit of a hedge, but to call this a hedging transaction, I think is really a misperception that can get people into a lot of trouble. So again, I'm not going to say that selling puts is necessarily wrong. It definitely has its risks and it's not for everybody. But I'm definitely going to say that it is not really a good hedge against your long shares. So for anybody who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.